Luke Stein here. This short video is going to introduce the question of how to calculate the cash flows that enter into all of our key capital budgeting decision-making tools. Whenever we make a capital budgeting decision, the management has to decide whether the cash flows generated by a project, typically in the future, are going to be sufficient to justify the cash flows associated with getting it going, which typically happen in the short term. So this is an investment project. It has costs as well as benefits, and those costs and benefits are measured in terms of the cash required and the cash generated. If we think about all of our key capital budgeting decision-making tools, including net present value or NPV, IRR or internal rate of return, or payback period, all of them have as key inputs the cash flows associated with the project. And that's going to include both the future cash flows, typically associated with benefits, so cash inflows that are generated over the long term, the life of a project, but also the cash outflows, which typically occur at the beginning and in a DCF framework are associated with the price that a firm should be willing to pay at most in order to get the project going. So how do we decide which cash flows we should be including when we calculate NPVs, IRRs, or payback periods? Well, one way that we often describe the sort of framework for thinking about what should and what should not be in these calculations is the so-called with-without principle. Relevant cash flows, according to this principle, are those that the firm generates or incurs with the project, but would not incur without it. That is to say, incremental cash flows. What is the firm going to bring in or pay out with the project that they would not if they did not do the project? So we're going to explicitly try to map out some of the benefits as well as the costs on a cash flow basis. In particular, most projects are going to be associated with some cash outflow in the initial stages of the project that we typically characterize as investment costs. And classically, that would be capital expenditure, so cash flows associated with the purchase of property, plant, and equipment to get the project going, and research and development. Those are cash outlays associated with figuring out how to launch, how to market a new product. So these are typically going to be outflows. They're typically going to happen at the beginning, but of course, there may be continued maintenance or installation or operating costs associated with getting the project going and operating that may show up on a set of formal accounting statements as CapEx or as R&D and don't happen just at the beginning of the project. On the benefit side, a lot of benefit associated with a classic project is going to be incremental revenue. So projects may be commercialized and the products associated with the project or a geographic expansion or an acquisition or anything else, once that thing is commercialized, it should generate new cash inflows for the firm, in part because they're able to sell more, whether those are incremental sales of existing lines of business or new lines of business associated with the product launch. Now, of course, revenues are not the same as cash inflows. Why? Well, you may sell a product and not yet collect for it. So that's going to, some discussion of that, which turns out to be very important, is going to come up in a minute. Of course, revenues are not only not cash flows, but they're also not even profits because we also have to subtract out incremental expenses that the firm would incur. So operating costs, the cost of goods sold, for example, the cash that the firm has to pay in order to commercialize the product and in order to generate those incremental revenues that we mentioned in step 2. So COGS, incremental cost of goods sold, are almost certainly going to enter into these calculations. Other costs associated with cash outflows may enter but may not. And this is a place where we're always going to have to be careful. We're trying to think about incremental costs and therefore incremental cash flows associated with those costs. A firm that has SG&A, selling general and administrative expenses, may need to increase the amount that they spend in those areas in order to launch and develop the new product or project. And in order to do, and if they have to do that, we should consider those associated cash flows incremental to the project, and we should include those incremental SG&A costs. On the other hand, a firm that has fixed or flat SG&A may, from an accounting perspective, seek to allocate some of those costs to this project. So often this happens in terms of internal cost allocation that may appear on the P&L statement that a given manager or project manager sees at the end of a quarter or a year. But to the degree that the firm was going to have to pay those SG&A or overhead costs even if the project did not get done, the fact that they get allocated for accounting purposes to the project is not relevant when we're calculating these cash flows. We only want to be thinking about cash flows that the firm overall is going to incur only if they do the project. So I mentioned earlier that not all revenues generate positive cash, and of course, not all operating costs or other associated costs necessarily generate negative cash flows, at least right away. Why? Well, because the project may be associated with a change in the firm's working capital, and this could be positive or negative. So working capital, and I'll have a little bit more to say about this in a few minutes, is the difference between a firm's current assets they hold on their balance sheet that they expect to use within the next year, and their current liabilities, debts that they owe that they expect to pay within the next year. And so to the degree that that starting a project is associated with an increase in working capital, say the need to hold additional cash in order to be ready to operate the project, in order to the extent that the firm has to hold additional inventories in order to launch the project, or that they sell products generating revenue, but they don't collect on those on those sales right away and generate accounts receivable, the firm is going to have a cash outlay, or at least a cash outlay that offsets some of the cash inflow associated, say, with revenue. Of course, the firm may also, through implementation of a project, be able, if they're lucky, to reduce their working capital. And that could be things like projects that allow them to collect more quickly on accounts receivable from customers, or that allow them to maintain higher levels of accounts payable. So somehow a project may allow them to receive more inputs from producers and pay for them more slowly. And to the degree that they can do that, that negative change in working capital is going to be associated with a positive cash flow for the project. So these four are not going to exactly match up with the way we might think about generating a profit and loss statement or an income statement for the project, but they're likely to be pretty close and bear some resemblance. The fifth point on the slide is super important, and that is when we think about the cash flows that the firm incurs only if they do the project, we do need to take into account indirect or spillover effects that the project might have either on the firm's existing business or on future lines of business that the firm might expect to start in the future. So just to give some examples, it may be that a new project commercializes really well and generates additional revenues far in excess of the associated operating costs. Looks like a slam dunk project. Well, to the degree that those revenues minus operating costs or positive cash flows come at the expense of the firm's existing business, people who might have bought the old model now just buy the new model instead, cannibalization or erosion of sales of existing products are a negative impact of doing the project. And even if they don't live on the manager of this product's or project's profit and loss statement, they still need to be taken into account when the firm decides whether or not the project is worth doing. So if new business cannibalizes or erodes, typically by being a substitute for some of the firm's existing lines of business, we're going to need to think about those offsets or those negative spillover effects on the firm's existing cash flow. On the other hand, the new project may be associated with complementarity with some of the firm's existing products. So it could be that either because there's a direct complementarity between the products, we've got one and now we want the other. I buy shoes and now I want to buy the matching handbag. It may also just be through things like brand building. So when there's complementarities, we want to think about positive or indirect spillover effects and include the related cash flows in an assessment of whether the project is worth doing. Another category of indirect or spillover effects operates if the firm is subject to scale economies. Positive scale economies or economies of scale might exist if, for example, purchasing more inputs in order to launch the new product allows the firm to negotiate discounts not only on their incremental purchases, but also to get a better price on what they were buying before. So that would be an example of a positive economy of scale. And if the new project is able to generate better pricing on inputs for the firm's existing lines of business, we should consider that positive effect from a cash flow perspective when we're assessing the current project. There's obviously also ways in which a firm might incur negative economies of scale, and we'd have to think about those on the negative side. So some of this is going to be a science, and the scientific piece of this is going to relate to the application of reasonable financial managerial accounting and the application perhaps of financial reporting rules, although a lot of this is actually about an art. It's about doing a good forecast, not only of kind of what's going to happen if the project gets launched, but also thinking counterfactually about how to do a forecast about what would happen if the project doesn't get launched in order to figure out which cash flows we actually think are incremental. And typically, accounting rules are going to have very little to say about how to do that. So let's try to sort of concretize this a little bit. When we calculate project level or incremental cash flows, we're sometimes going to think about those as being associated with incremental free cash flows. And free cash flow is a powerful tool for thinking about a particular set of the cash flows on a firm's cash flow statement that we will also often use when we do valuation either of firms or of projects. So the calculation of incremental free cash flows is going to involve period by period figuring out all of those things that are on the previous slide. What cash flows are associated with doing the project that the firm would not generate or pay if they didn't do the project. And in particular, what we want to think about are what are the cash flows that are going to be available to be distributed to the firm's capital providers. So what cash flows are generated that could, in theory, be paid out either to lenders or to equity investors. So when we think about free cash flows, we're going to think about four key components. The first is going to be earnings before interest and taxes. And of course, again, here what we want is incremental EBIT. So the EBIT impact of doing the project in excess of what the firm would generate if they didn't. We're going to take that incremental EBIT, which of course for the firm as a whole lives on its income statement, for the project may not necessarily live anywhere and need to be forecast. And we're going to multiply that by 1 minus the tax rate in order to take into account the fact that when the firm generates additional EBIT, they are also going to have to pay additional taxes. And so the after-tax cash flow associated with that EBIT is going to be smaller if the firm has to pay taxes on it. And we get that by multiplying the incremental EBIT impact by 1 minus the tax rate. The second thing we're going to do is we're going to subtract off whatever investment the firm needed to make in that period in operating net working capital. So if the firm increases its net working capital, that's going to have a negative cash flow impact. If it decreases its net working capital in the period, that's going to have a positive cash flow impact. And the only thing that might look a little bit new or different here is this operating. So sometimes a firm has to, in order to implement or operationalize a project, invest in cash in net working capital for purely financial reasons. They might, for example, take on short-term debt, financial debt in the forms of notes payable is something that you'll sometimes see on a balance sheet. The firm may wind up holding excess cash that's not needed in order to run the project operationally. And because free cash flow is an operational concept, it's focused on the cash that's available to be distributed to capital providers, including lenders and equity investors. We actually don't want to include any change in net working capital, which is strictly associated with the way that the project is financed. We only want to include changes in net working capital that are associated with the actual operations of the project. And sometimes that's going to require a little bit of judgment. The third thing we're going to look for is CapEx, or capital expenditure. So what's the cash that needs to get spent or paid, I should say, in order to purchase new property, plant, and equipment? And that would be a positive CapEx or capital expenditure, which is going to show up getting subtracted here. But it's also possible that the firm is going to have negative CapEx, which would typically have to do with selling off property, plant, and equipment, typically at the end of a project's lifetime. And that negative CapEx could generate a positive incremental free cash flow because the firm collects when it sells stuff off. More on that to come. The final thing that we're going to do when we calculate incremental free cash flows is we're going to add depreciation back in. Now, this is a little bit subtle, and I'll have more to say about it in a minute, but if you think about where depreciation lives on a firm's income statement, depreciation is an expense, and so when we calculated EBIT, we've actually already subtracted depreciation out, despite the fact that the firm did not pay that depreciation as a cash flow. It was kind of an accounting convention associated with the loss in value of the firm's property, plant, and equipment. But because we subtracted depreciation when we calculated EBIT and the firm didn't pay it as a cash flow, we have to add that depreciation back in here. Okay, so that's kind of the idea. We're going to think about incremental EBIT, multiply it by 1 minus the tax rate. we're going to subtract off the change in or the increase in operating net working capital. We're going to subtract off capital expenditure, and then we're going to add back in the depreciation that we subtracted out to get EBIT. And just a reminder at the bottom of the slide of what EBIT means, adding incremental in front of each term, because that's what we're looking for here. We're going to be looking to take incremental revenue or sales and then subtract off any incremental cost of goods sold, any incremental selling, general, and administrative expense, any incremental depreciation and amortization, although again, we're going to add that back in, and any incremental research and development expense. So, key implementation points. What goes in? CapEx goes in. Let's make sure we put the CapEx in there. Even though CapEx would not typically show up on a firm's income statement, it should show up here. Second, we're going to include incremental research and development and market research. The key thing here is only if it's incremental, only if the firm only does it if they do the project, but not otherwise. And one thing we have to be careful about here is to try to make sure that we're avoiding including sunk costs. So if at the time that we are engaging in this capital budgeting analysis, the R&D has already been done, the market research, et cetera, has already been done, that means that the firm will be paying those cash flows whether or not they do the project. They've already done them. So we're going to make sure to exclude sunk costs. We only want to include incremental R&D and market research. And if it's already been done, it's sunk. It can't possibly be incremental. Third thing, we're going to try to make sure to include taxes, or at least the tax impact that occurs through increased or decreased EBIT or earnings before interest and taxes. And you can see that's what we did when we multiplied incremental EBIT by 1 minus the tax rate. The reason I'm clear to say taxes, but on EBIT here is the firm may also have a tax impact associated with financing the project. So maybe in order to do the project, the firm may have borrowed more, and that debt may generate some tax shield benefit or something like that. It's not that that's not important for capital budgeting analysis, but to the degree that the taxes are associated with the firm's financing rather than the firm's operations, we're going to include that elsewhere in our capital budgeting analysis. In particular, when we calculate a weighted average cost of capital, a WACC, we're going to use the after-tax cost of debt. So if there's a tax impact of financing, we don't want to hear. We only want taxes generated by the operating component of the project, which we're going to do by multiplying EBIT by 1 minus the tax rate. And the last thing I would mention, probably not something that you need to worry about, but we are, when we do our free cash flow forecasting or incremental free cash flow forecasting for capital budgeting, we are going to do everything in nominal dollar terms generally. And that means that we should expect that, especially for long-lived projects, the size of the cash flows may go up. So if prices are increasing due to inflation, revenue would go up faster, but costs would also go up faster. And typically we're going to do our capital budgeting in nominal terms. And to the degree that inflation drives the cost of debt or the cost of equity higher, because investors expect compensation for having to wait to get their money back and prices may be higher in the future, we're going to put it in there. That turns out mainly to be important because the tax system calculates taxes in nominal terms. And so we want to make sure that we're doing things in dollars rather than in real amounts. So depreciation is going to get, in a sense, excluded. You see it in the formula, but it's going to get subtracted out from EBIT and then added back in. Why is depreciation going to matter? Well, as we'll see in a minute, it's going to matter because it has an effect on taxes on EBIT. We're going to make sure to exclude sunk costs. Anything that the firm has already paid can't be incremental. It can't satisfy the with without because it's already been paid with or without the project. I mentioned earlier that we're going to seek to avoid allocated overhead. So even if a project-based profit and loss statement is going to get charged some headquarters cost, we're going to charge you a portion of the firm's marketing budget, or we're going to charge you a portion of our managerial overhead. If the firm is going to incur them even without the project, we don't want to include them for capital budgeting purposes. And then finally, we want to make sure only to be thinking about operating cash flows associated with the project. So if there's financing costs, if the firm has to pay interest on the loans it uses in order to finance the project, if it has to pay dividends to shareholders on shares issued in order to finance the project, that's all well and good, but we'll capture that elsewhere. We'll capture that through our hurdle rate, through our weighted average cost of capital, et cetera. So here's how a typical project's cash flows are going to wind up looking. Most projects are going to have some initial outlay that's going to happen either at kind of time zero or in the early stages. And that's going to be associated with capital expenditure that's going to generate or R&D that's going to generate negative cash flows for the project up front. So we would typically expect that the cash flow impact of purchasing equipment is going to be negative, that initial R&D costs are going to generate a negative cash flow, and most projects are going to require an initial increase in net working capital. So in order to get the thing going, we're probably going to have to build up inventories. We may have to increase the amount of cash we have on hand. We may have to put raw materials in factories. So typically, we're going to see that most projects have a negative initial outlay. And you should think about the sort of typical investment cash flow pattern that we've described all along, where initially projects have an initial outlay which is negative, followed by positive benefits in the future. So what do those positive benefits typically look like? Well, over the course of a successful project in kind of the middle of its life, it's hopefully going to generate positive incremental revenues. It's likely to generate incremental costs, but hopefully the incremental revenues are going to outweigh the incremental cost because the project is profitable. If it's profitable, some of that profit is going to get dissipated in the form of a higher tax bill. But again, these three are hopefully still netting out to be positive. So a successful project will typically be kicking off cash in the middle part of its life. And then we don't really know what's likely to be happening to net working capital over the life of the project. So inventories might be going up or down. Raw materials might be increasing or decreasing. AR or AP will change with the payment structure. But hopefully the project is going to be able to generate positive cash flows ongoing. Now, some projects just kind of go on forever, but most projects are ultimately going to get shut down in one fashion or another. And sometimes that is going to generate what we'd call a terminal cash flow, which is hopefully or usually positive. So typically what's going to happen is there may be some old equipment which can get sold off, even if for not very much money. It could get scrapped or salvaged, and hopefully that's going to generate a positive cash flow when the stuff gets sold. There may, however, be some shutdown costs, so you may have to pay money in order to get things to stop. You may have to buy out workers who are getting retired or lay it off. You may have to pay for environmental cleanup or disposal of excess stuff. But there's also usually a decrease in net working capital as the final inventory gets sold off, as the final raw material gets used up, as the cash that the project needed to have on the balance sheet can get returned to the firm overall as a whole. So if you look at this, you might see something that looks, a little bit like what sometimes the pattern of cash flows might look like for a bond from the bond investor's perspective. A big negative cash flow initially associated with the initial outlay and investment, some perhaps small or smaller ongoing cash flows over the life of the project, in some ways analogous to coupons, although they won't be equal and equally spaced, and then potentially a larger positive cash flow that comes at the very, very end of the project associated with the sale of equipment and the decrease in net working capital. That's the terminal cash flow that happens at the end. So a note about this operating net working capital calculation and what this is. So net working capital is associated with the difference between a firm's current assets, that is to say the portion of its assets that it intends to use within the next year, and the firm's current liabilities, the liabilities that it expects to pay within the next year. And so typical things that we might think about entering into that are going to be cash that the firm needs to have around to do the project, AR, so things that it sells before it collects them, inventories, things that it's made that it hasn't yet sold yet, and there may be other current assets, including things like work in progress or raw materials. On the liability side, AP, so supplies that it has collected and used to generate sales but hasn't yet paid for. And then there may also be some financial liabilities, so not operating liabilities, including short-term debt. So if it's done short-term borrowing that it expects to pay back within the next year, and we'd often see that called notes payable if it wasn't called short-term debt on a firm's financial statements. So the difference between those two, current assets minus current liabilities, is called net working capital. And if a firm is increasing its net working capital, it's going to need to find cash in order to do that. And so an increase in net working capital is going to generate a negative cash flow for the firm. The liquidation of net working capital is going to generate a positive cash flow for the firm. So when we calculate these project cash flows, we want to think about net working capital changes But in particular, we want to focus on the operating piece. And basically, that means we're going to want to think about how much cash a firm is going to need in order to operate the project, how much AR it's going to have when the project is getting operated, how much inventory they're going to need to operate the project, and then subtract off accounts payable. There may be some other current assets, operating current assets. There may be some other operating current liabilities, but these are typically the big ones. And once we've estimated the operating net working capital associated with the product, we can use changes in that period by period operating net working capital forecast in order to think about the cash flow impact of the changes. Okay. So, generally, we're going to forecast period by period operating net working capital, and then we'll use that to think about changes. So a quick example on that one, suppose, for example, that a firm is considering launching a project that's likely to have the following balance sheet impacts at the project level. So in order to get started at time zero, the firm expects to build up 75, let's say these are in thousands of dollars of inventory. They expect initially right away to generate $25 or 25, let's say $1,000 of accounts receivable, but $40,000 of AP. And then suppose that over the course of the life of the project, so after that initial investment in time zero, they expect that instead of these fairly ad hoc forecasts, they will always need to maintain for the project net working capital equal to 5% of sales, and that they've generated a sales forecast going forward for the next 3 years. And then finally, suppose that at the end of the project, they expect to be able to liquidate all of the associated net working capital. So if we move over to Excel and we take those numbers and we put them into the forecast, we might say that the forecast suggests that the firm expects to generate $75 worth of inventory, $25 of accounts payable, and $40 of accounts payable, and $25 of accounts receivable, for a total net working capital over those by the end of year zero of 140. No, that's wrong. What's wrong? Well, net working capital is current assets minus current liabilities. So what I need is to make sure that I'm adding the inventory side, which in this case will be AR and inventories, minus the accounts payable side. Okay, that's going to be, what did I do? Put in the wrong numbers. So the slide suggests inventory of 75, accounts payable of 40, and AR of 25. So I think I am, nope, that's equals AR plus inventories. Those are assets minus accounts payable. Sorry about that. So 60 is going to be our forecast. And I don't know what that one's about, but let's get rid of that. And what about in time one? Well, we said that over the next 3 years, they're going to have sales of 5,000, 6,000, and 3,000 respectively, and that total net working capital in those years was going to be 5% of the sales forecast. Okay, so we have a net working capital forecast for years 1, 2, and 3 of 250, 300, and 150 respectively. And then what's going to happen after the project gets liquidated? Well, our assumption is that the project is no longer going to have any working capital associated with it anymore. So in the first year, what's our cash flow impact going to be? Well, the increase in net working capital is going to be the 60 that the firm needs to build up. But starting in year one, it's going to be associated with the difference between this end of year's working capital minus the end of the previous year's working capital. And so in year one, they're going to have to increase working capital by 190. In year two, they're going to increase working capital by 50. In year three, they're going to decrease working capital by 150 because sales are going down. And then finally in year four, they should be able to liquidate all of the remaining working capital that they have in place. And if we go back to our project level incremental free cash flow calculation formula that we mentioned earlier, that investment in operating working capital is going to get subtracted in the calculation of incremental free cash flow, which means that those positive changes in net working capital that happen in years 0, 1, and 2 are going to be associated with negative project cash flows. So the firm is going to expend cash in order to build up that net working capital stock over the first 0, 1, 2 years of the project's life. And then the negative changes in net working capital in periods 3 and 4 are going to be associated with positive cash flows. The project is going to kick off cash as that working capital gets liquidated. So, last thing to say about depreciation. So I mentioned that depreciation is included in the calculation of EBIT and gets subtracted as an expense and then gets added back in. So how do we calculate depreciation? Well, 2 typical ways that the accountants tell us to do this. The first is so-called straight line depreciation. So straight line depreciation says that we're just going to take the difference between the value of the asset when it gets purchased, that's its initial cost, and the expected value of the asset at the end of its life, the amount that it could be sold for when it gets scrapped, and that's called its salvage value. We take the difference between those two, and that's the total decline in value over the life of the asset, and just divide that by the number of years that the accountants tell us that the asset should be expected to be in use. And critically, you can kind of see if the salvage value is 0, which is a not atypical assumption. So if we assume that once this thing has been used up, it's worth nothing, that means that annual depreciation is just going to be the initial cost of the product or the capital good divided by the number of years that we expect it to last. So if that salvage value is 0, then that asset will be fully depreciated at the end of its life. And that number of years should, in theory, reflect the useful life of the asset, although the accountants don't necessarily take into account business realities. And in particular, often businesses like to be able to ascribe shorter life cycles for depreciation purposes to their assets. And so they may sort of be allowed by the accountants to use an exaggeratedly short period of time there, depending on the rules. The other common possibility is that firms use for particular goods what's called accelerated depreciation, where the MACRS or modified accelerated schedules are what they're allowed to use. And this is going to involve a depreciation table, which is going to vary by asset class based on accounting rules, and then going to involve multiplying the initial cost of the good by some annual percentage, which is read off a table. So if, for example, you have a good that, according to the accounting rules, has a 3-year life cycle, and you are able to use MACRS or modified accelerated depreciation, you're going to be allowed to depreciate a third of its life or of its value in the first year, but then 44% of its value in the second year, only 15% of its value in the third year, and 7.4% of its value in the fourth year. And you can see included here similar schedules, something that no one should ever memorize and you would always look up for longer asset lives. And one thing that you may notice if you're paying a lot of attention is the slightly strange idea that even though, for example, we called this a 3-year depreciation schedule, it involves depreciating the asset over 4 calendar years, with a low 7.4% depreciation in the fourth year, and then somewhat surprisingly, a lower depreciation rate in year 1 than in year 2. And the reason for that is that part of this accelerated depreciation convention is the assumption that assets get purchased in the middle of the year. And so that's sometimes called the mid-year convention. And so the 3-year depreciation schedule is going to involve depreciation in 4 different fiscal years, where there's a small amount of depreciation in the first and the fourth year, because the assumption is that the asset is only on the books for, on average, half of that year. And you can see the same thing for all of the other schedules. So the 5-year schedule has lower depreciation in years 1 and year 6. And so there's 1, 2, 3, 4 full years of depreciation. And then the 5th year is kind of a half year each in year 1 and year 6. So that's the mid-year convention. And this is something that you may have some chance to practice, but that typically in your life, you would rely on an accountant to help you work through this stuff. So depreciation matters. And the only reason that it matters, but it potentially matters a lot, is because of taxes. So that free cash flow formula says, we're going to calculate EBIT, which includes the subtraction of depreciation, and multiply by 1 minus the tax rate. But then we're going to add the depreciation back in at the end. And so just based on the formula, you may notice if there's a lot of depreciation, okay, so if an asset depreciates quickly, that's going to lower EBIT and it's going to increase depreciation here. But what's going to happen to free cash flow? Well, if there's a lot of depreciation, because EBIT gets multiplied by 1 minus the tax rate, the free cash flow associated with the project is actually going to be higher. So depreciation increases the free cash flow associated with a project because it gets subtracted, but the piece that gets subtracted gets multiplied by 1 minus the tax rate, but the whole thing gets added back in. And that's part of the reason that firms prefer typically to use accelerated depreciation schedules when they're allowed to, is that more of the depreciation happens sooner. So rather than depreciation being on a 3-year schedule, a third, as it would be with straight line, it happens a third, 40%, 15%, 7%. So more of the depreciation is front loaded, and that's going to increase the free cash flow in the earlier years of the project's life cycle, which increases its NPV, it increases its IRR, and it increases its payback period. So it may seem like, hey, depreciation is a great thing. Firms should seek to depreciate as much as they can, as quickly as they can. It turns out that depreciation matters not only for income taxes paid on EBIT, but it's also potentially going to affect a tax bill that a firm may have to pay at the end of the project on capital gains when they liquidate the property, plant, and equipment. But we're going to hold that discussion for another video.